Welcome back to Successful Living. The stock market, home sales, and of course interest rates, all at very positive reflections of good numbers and what's going on. And to join us today to talk about mortgage interest rates is our mortgage expert from Homestar Mortgage, Steve Tetzner. Hey Steve, thanks for joining us again.
Pleasure to be back.
Hopefully, as I've always said, it looks like we're getting close to getting you back in here, but as we've all said, whether it's personal or business, we're ready for COVID to be gone, I think.
Absolutely. I'm done with it.
Yeah. So can you give us a little update? You know, I know things are probably in a very good place, but can you give us a good, an update at where rates are currently?
Yeah, so rates are at all-time historic lows right now. We're seeing purchase money, people buying houses with good credit, interest rates down on a 30-year mortgage as low as 2.5%. 15-year mortgage rates are down around the 2.25% mark. And there's a lot of interesting things that are happening in the market right now. So consumers really need to do some due diligence in this market to look at multiple lenders and do a little bit of shopping around to try to find good rates. It's getting difficult for the consumers because the rates are so low and there's so much business that lenders are literally shutting off the spigot. They are raising their rates just to slow down the amount of business that's coming through the door because nobody can manage it and nobody can handle it. Our 30-year rate was 2.5% this week with no points on a 30-year, and I was hearing lenders that were 3% and higher for the same transaction. So it's really important in this market for a consumer to do their diligence and shop around a little bit to find a good rate.
So just to clarify, they're increasing the rates because they need to slow it down, not even just to, well, they're going to make more money, but they're just saying we can't take this on anymore. We almost want to deter people in a sense to not take it on, or we need to just charge them more because we don't have the capacity from the employee's standpoint to be able to process these loans. Is that correct?
Yeah, crazy as it sounds, that's exactly it. I mean, we are processing 3 times the amount of business that we normally do with the same staff. I mean, we were able to get a few people to supplement here and there with some administrative and clerical things, but to do what we do it takes training and it takes a lot of experience to process the mortgage. We have our own vocabulary in the mortgage world. So it's not like we can just hire somebody off the street and they can come in and stop processing somebody's mortgage for us. So it's very difficult to find good people in this market if you're an employer in the mortgage side. And, literally, there's just so many people trying to either refinance or purchase right now. The lenders cannot keep up with the capacity. It's just crazy.
Yeah. So now would the expectation be from the time that you kind of sign up for a loan and put your application in that I would assume it's not 3 times longer than it was last year. The process has to speed up a little bit from maybe where it was before. I guess what I'm saying is, can people lose a rate because it's taken too long to process loans where they go, or not really?
Well, I guess technically they could, but I know what we're doing is, normally when we would do a refinance, we would lock the customer's rate for about 45 days, and we could process the loan, close the loan, fund the loan, get it all done within a 45-day period. Now, because of the loan volume, we really can't do a refinance in 45 days. It's taking closer to 60 to 75 days. So what we're doing is we're locking people's rates for 75 or 90 days when they apply for the loan, so that we're sure that we're going to be able to have ample time to process the loan and get it closed so that the consumer will not lose the rate that they were promised.
Okay, so are you finding that bigger banks are kind of increasing that fee and the smaller lenders might have a little bit more leeway in, being able to say, listen, we can process your loan for a lower rate? I mean, are you seeing smaller lenders like yourself having more ability to do that?
It's all over the map right now, to be honest, Rob. In and out of the market on a daily basis. They'll come in and they'll have an aggressive rate for 3 or 4 days, bring in a ton of business, and then they'll price back out of the market again to slow things down again. So it's really almost on a day-to-day. It's really crazy. I've been doing this for 25 years, and I've never seen volume like this before in the mortgage industry.
All right. Well, I guess good and bad for you, but staying busy and getting a lot of business is a good thing. So.
Yep.
All right, so tell people they need to shop around. They can't just say, oh, I walked into my bank and this is where I do my banking, therefore I'm just going to do my mortgage there because rates sound like they're lower than they were in 1980. Just make sure that you do your due diligence. So I want to make sure our viewers make sure that they do their homework.
Absolutely.
All right, so switching topics a little bit. Recently, there was a refinance fee implemented on mortgages. Can you tell us what that fee is and why that's there?
Sure. So recently what happened is the government, as you know, is basically still overseeing Fannie Mae and Freddie Mac. So back in August, Fannie Mae and Freddie Mac said, you know what, we're going to lose $6 billion as a result of COVID. So we are going to, sorry, did you lose me?
No, you can still talk. For some reason, I believe this changed a little bit, but there we go. You're back.
Oh, okay, thanks. Sorry. Technology.
Again, we'll get you back in here soon, so I don't have to worry about that.
Sorry about that. Yeah. So what happened is Fannie Mae and Freddie Mac were basically being, overseen by the federal government still. So back in August, they realized that as a result of COVID, they're looking to project about a $6 billion loss as a result of COVID, with people that are going to either default because of loss of job, forbearance, or what have you as a result of COVID. So they're trying to make that $6 billion up. And with the rates being so low and so many people refinancing, what they came up with is what they're calling an adverse refinance market fee. So anybody who's refinancing now, if the loan amount is $125,000 or higher, Fannie and Freddie have implemented a 50 basis point or a half a point penalty for all refinance transactions, an additional fee. So what that means is that's not a 0.5% to the interest rate. It's a 0.5% of the loan amount. So if somebody's refinancing a $200,000 mortgage, it's an additional $1,000 fee that's being implemented on the loans for the refinance. Now, this can either be built into the interest rate or the borrower can pay it. So in other words, let's say somebody's buying a house and they have the same situation, same credit score, same equity position, same type of property as somebody refinancing, and the person buying is getting a 2.5% interest rate with no points on a 30-year fix. That means that that same person refinancing is getting a 2.5% rate, but they have to pay a 0.5 point upfront fee on the loan. So they can either opt to pay that additional fee out of pocket, rolling it into the closing costs, or they can take a slightly higher rate and build that in. So someone who's buying a house and somebody who's refinancing a house right now is actually getting a different interest rate on their mortgage. So this started back in August, where Fannie and Freddie came out and said, okay, we're implementing this fee effective immediately, which was September 1st.
Yep.
And the lenders across the country went wild because they said, well, we have these massive pipelines that we priced out based on the pricing that you gave us. And now you're telling us all these loans that we have in process, you're going to hit us with an additional 0.5 point fee, which means every lender would have lost a 0.5 point on every loan across the country.
Wow.
So the government stepped in and said, hey, you can't do that. We're going to let you charge the fee, but we're moving the implementation date out to December 1st. So when they talk about the implementation date, it's not the date that the loan was originated. It's the day that the lender delivers the loan to Fannie Mae. So in other words, someone like myself, we take the loan application, we process the loan, we approve the loan, we close the loan, we package the loan, and then we sell it off into the secondary market. So the date that that loan is actually delivered in the secondary market to Fannie Mae is the date that the fee hits. So they put a December 1st date on that, which means that lenders across the country basically implemented this new fee into their pricing and their rate sheets on October 1st, so that they would have time to, actually some of them did it in September, they would have time to process the loan, close the loan, and deliver it to Fannie without getting hit with the 50 basis point fee, which now when somebody's refinancing, it's built into the rate that they're paying. So they don't realize it, but they're actually paying a slightly higher interest rate as a result of this fee to the government.
Okay, and that fee is not going to the lender, just to clarify for people, that's going back to the government, correct?
It's going to Fannie Mae and Freddie Mac, which basically, is being overseen by the government. So the government gave them permission to charge this additional fee on refinance transactions.
Yeah.
So they didn't implement it on people buying houses because they want to keep that market as active as possible. But they basically said, look, there's so much refinancing out there and there's so much money out there on the table, we're going to grab a little piece for ourselves.
Gotcha. Okay, the next question I'm going to ask you could take us 25 minutes. I especially know that you've got a lot of points of views probably when it comes to maybe some politics, but my question just in general would be, with the election coming up, just thoughts on where things could go, you know, depending on, you know, who would get elected, and, or even just the time frame for the next 3 months. Where do you, what's your feeling and where we're going with interest rates for the next 3 months?
Rob, I honestly, I have no idea. If you asked me a year ago, I would have never told you that the 30-year mortgage would be at 2.5% right now.
Yeah.
I don't know what's going to happen with, depending on who gets elected, with mortgage rates. I mean, there's a lot of speculation on what's going to happen with the economy. You know, the general rule of thumb is when the economy is thriving and doing well, interest rates go up. When the economy is doing poorly, interest rates go down. So as a result of COVID, that's why we're seeing these poor interest rates, because obviously the economy is stalled as a result of COVID and people losing their jobs and, you know, the airlines going out. It just, the craziness in the world. When all that settles, you know, how long is it going to take to recover? I mean, your guess is as good as mine.
Right. Yeah. Now, I believe you probably have the right answer there. Unfortunately, we'd all like to know the answers. So my last question to you, and this comes to, you know, I've known you now for over 10 years, which has kind of flown by, but I talked about the word passion, and when I think about what you do in your career, the one thing you bring is a passion for the mortgage industry. And it's not, you don't just know interest rates, and we've only touched the surface of some of the stuff that you know. To me, you really dig in and you give great educated answers to stuff. When you first got in the industry, I mean, what drove that passion? I mean, is it to help clients? Is it to make money? Is it to build a business? I mean, what was it that really pushed you? Because you do a great job in what you do, and I mean, you are a wealth of knowledge. It's not like your common mortgage lender. You tend to know an overall view of everything.
Well, thank you very much for that. You know, when I first started out in the business, it was a matter of, you know, trying to build a career and do business. But then as I became more involved, I really, like you said, I got a passion for the industry itself. So I got very involved in the industry, and I wanted to be involved in not just understanding mortgages and how to process and close loans, but I actually got involved with lobbying for the mortgage bankers. I've been a member of the Mortgage Bankers Association. I've been, you know, on their board of directors. I was president of the Rhode Island Mortgage Bankers. So that's the passion that I really feel towards our industry, that it's not just about, you know, taking care of a customer, but it's also about making sure that our industry is going in the right direction.
Great. Well, Steve, as always, thank you for all the knowledge that you have, and you're helping our viewers make good decisions. So we will see you next time. Thank you very much.
Sounds great. Thanks.
All right. When we return, we will talk about the stock market and the upcoming election. Stay tuned.